Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about inflation and how it might impact your retirement plan. Obviously, if you stop working, the cost of everything you need to buy each month goes up and up and up a little faster than you expected. That could put some pressure on your retirement plan. But today we go into some technicalities and details and research on what the data tells us and how we might plan for that and incorporate this concept into your retirement planning. Because just like we can't expect the returns that we get in our investment portfolio to be consistent every single year, we shouldn't expect inflation to be consistent either. And that has wide-reaching impact for retirement planning. So we talk about those details today, as well as some recent research on this topic, which I found very useful and interesting, and I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hello, everybody. In this week's podcast, we're going to talk all about retirement and inflation. And there's been a lot of interest here recently, particularly over the last 12 months, obviously, with inflation levels very high, of how surrounding how inflation might impact retirement planning in general, how it might impact your retirement plan. Obviously, if you're someone who relies on a pension or social security, you have a fixed income coming into your checking account every single month that you need to use to pay your mortgage and groceries and all that. And if the price of groceries goes up, then that impacts your retirement plan and really the whole kit and caboodle. If you're someone who has retirement savings built up in a 401k or an IRA or a taxable investment account, and you're taking money, assets out of those accounts to put in your checking account to fund your retirement income, to pay all those living expenses, then if the price of the goods that we need to buy every month is going up and up and up faster than we're used to or we had planned for, then that can obviously put additional stress on your retirement plan. And inflation is still higher than our central bankers really want. It's higher than a lot of people expected, I think, in their own retirement planning. And I just wanted to talk through these issues today because there has been some study into this this particular issue. And I really wanted to hone in on the impact of variable inflation. And the best analogy I can use here is something we've talked a little bit on the podcast about is sequence of returns risk. But we need to think of inflation as, or when we think about retirement planning, we need to think of our retirement plans as having sequence of inflation risk just the same as sequence of returns risk. So I wanted to talk through this a little bit. There's a really good article that came out on Michael Kitzis's website here recently about how variable inflation could impact your retirement plan. For those of you who've not heard that name before, Michael Kitcis is kind of a financial advisor, financial planner facing person. He's got a whole bunch of businesses in the industry that support advisors. He and his team of researchers are very sharp. They're very good at looking into this stuff. Anytime personally I'm working with a client or I have a question about how something going on might impact our clients or impact some element of their financial planning, I go to his website and usually they're 2 steps ahead of me. They've already thought of the exact question that just popped up in my head. They've researched it and they've published this, sometimes 3,000-4,000 word article on all the technical details that is just exceptionally helpful for a practitioner. So the data that we're going to cover today is not firsthand. This is not research I did myself. This is coming from a variety of articles, a lot of which is going to come from kitsis.com. And I encourage anybody who's interested in these kinds of technicalities and into the research, or if you're just interested in the stuff that professional financial people look at ordinarily, I would definitely check out his site. So let's start with some of the basics just to get us going. And for those of you for whom this is repetitive, redundant, I apologize, but it's a very helpful foundation and baseline for those of you who are unfamiliar with just basic retirement income planning. And really that all starts with the 4% rule. There's been a lot of discussion over whether the 4% rule is still valid. I think it's still a pretty helpful rule of thumb for a lot of people. The reality is the 4% rule is too rudimentary for 99% of us. And the 4% rule goes something like this. Back in the early 90s, there was a financial planner, somebody that did something very similar to what we do here at our firm, and they had a bunch of clients who were approaching retirement. And one of the fundamental questions that people in that situation are trying to solve and trying to answer is, do I have enough to stop working? When you're working, you have income coming in from work, you pay tax on it, you use that income to pay your expenses, and hopefully you have a little bit saved up, or left over at the end of that you can use to save for your future. And that little bit of savings goes into an account, hopefully you invest it and it grows. The size of that nest egg grows and grows and grows, and at some point it's large enough to where you don't have to continue working to pay your future living expenses. Your wealth is large enough to pay those expenses for you. That's the retirement transition. And what this practitioner, Bill Bengen, was trying to confirm was that his clients had sufficient enough nest eggs to be able to shut off their income, take a little bit of money every year out of those nest eggs to pay their expenses, and have some confidence that they're not going to run out of money if they live a little bit longer than they were expecting. And so what he did is he pulled a bunch of data. He assumed that they all had retirement portfolios invested in 60% stocks, 40% bonds. The 60% he assumed were invested just directly in the S&P 500. The bonds, I think he used 5-year T-bills for the 40% invested in bonds. And then he used a 30-year rolling retirement timeline. And that seemed to match up pretty well with his clients. They must have been retiring somewhere around 60, 65. If you use a 30-year period, then, back in the early 90s, that gives you some pretty reasonable confidence that most of his clients are going to be deceased by the end of the third 30-year period, just based on life expectancies at the time. So he got as much data as he could. He went back to 1927 and he calculated 27, not arbitrarily, just because that was when the data set he was using became available. And he assumed that he calculated someone retiring in 1927 invested 60% stocks, 40% bonds, living for 30 years. How much can they take out of that portfolio every single year, adjusted for inflation, and not run out of money at the end of the 30-year time horizon? So he did that exercise for 1927 to 1950 through 1956. And then he slid the 30-year period forward. And he did the exact same exercise, 1928 through 1957. And he kept going until he ran out of data. This paper was published in 1994, so it must have been 1964, I guess, through 1993 is what I'm guessing his data set would have ended with. But he had all these rolling 30-year periods. He determined the maximum amount someone with that basic portfolio could take out every single year. And the one rate that worked in every single scenario, even the scenarios with the least fortunate timing, meaning retiring right before some huge market crash, was 4%. And if you think about it, that covers a pretty good swath of economic history. 1927 was the end of the booming 20s. We get into the 30s, where we're now all of a sudden in the Great Depression. We have really, really bad market losses in the early and mid 30s throughout the Great Depression. Then Japan attacks Pearl Harbor. All of a sudden, we're in the throes of World War II. We kind of spend our way out of the Great Depression. There's a quick dip and a little bit of inflation there when the troops come back home because everybody is working again. Everybody wants to buy houses and buy stuff. There's not enough goods available at the time. Through the 60s and the Korean War and Vietnam. And then when we leave the gold standard in the early 70s and we have the Bretton Woods Agreement and high inflation, it covers all of that economic history. And so being that today, the Great Depression is really the worst market environment that we've ever seen in this country, that's been used over the years as a pretty good barometer. And so if you calculate this yourself, if you have $1 million saved up for retirement, what the 4% rule means, if you trust it, is that you can take 40 grand a year out of that portfolio and you'll be okay for 30 years. You're not going to run out of money. And that 40,000 doesn't stay consistent. It increases every year by the inflation rate. So if you have 40,000 in year one, and inflation is 2%, which is the long-term benchmark for our economists, the decision makers at the Fed. Then in year two, you can take out $40,800. So the distribution does adjust for inflation. Now, this was kind of groundbreaking insights from Mr. Bengen after his paper was published. The paper caught fire. There was a whole lot of ancillary research or follow-up research as a byproduct of this paper. And the next iteration of it was what's called the Trinity study, which is a group of academics out of Trinity University, which I believe is in Texas. And they basically expanded on his work. So rather than assuming that you're in a 60-40 portfolio for the entirety of the 30-year time horizon, they tinkered with different allocations. What about 50-50? What about 100% stocks? What about 0% stocks? And then they also tinkered with it across a variety of timelines, starting with 15, and I think they went up to 40 years in 5-year increments. And so for people who are retiring early or retiring late or are more conservative or more aggressive investors, this was really helpful. And so since the Trinity study, I want to say, came out later in the 90s, and since then, there's just been a whole lot of research going down the same line of thinking of, if you're consistently invested in a certain allocation with certain asset classes, how much can you take out using this rolling history as a guide and be okay? So that's been helpful. And interestingly, since 94, we're now in 2023, so we have exactly another 30 years of data, another 30 rolling periods that we can use as kind of an addendum to the 4% rule. What we found is that in 2/3, and this is research published by Kitces' site, by the way, if you use the 4% rule, every year since, I think he went back a little further because now additional data is available. If you start in 1871, and you go all the way through, I think it's through 2020 was the most recent update to this. If you only take 4% out of your portfolio every year, in 2/3 of those rolling 30-year periods, you end up with more than twice what you started with. And it's only a very, very small portion, I think 10% maybe, where you wind up with less than you started with. Okay, that's if you take a $1 million portfolio, that's not working the portfolio down to $0 10% of the time. That's working the portfolio down less than $1 million in only 10% of the time by the end of the 30-year period. So a lot of people have become a little bit more comfortable with more aggressive distributions in a retirement planning sense. And on top of that, we're now using more Monte Carlo simulations, which are helpful because you can run 1,000 trials, which is what most software supports, I should say, where the software that you might use, you plug all your information into a really fancy piece of retirement income and planning software. The software knows your tax situation. It knows how much you need to take out every single year. And it has this big database of all the returns of all the asset classes you might ever want to invest in. And using history as a guide, they can run 1,000 different trials knowing the probabilities that these asset classes go up by their average or down by their average, or the standard deviations, high or low. And it can give us a pretty complete picture of whether your retirement plan is on solid footing or whether we need to make some adjustments to it off the bat. And the output of that is a percentage chance of not having to make any changes to your plan. So that means that if you have a 75% outcome, that means that if they run 1,000 trials, in 750 of those trials, did your plan work without you ever running out of money through the terminal date? And most people like to use age 90, 95, 100, something like that. So this Monte Carlo evolution is what most practitioners use these days, and that helps us account for what's called sequence of returns risk. And the one side of this is, if you think of it mathematically, you have 30 years of different returns that you might experience in your investment portfolio after you retire. And the average of those returns might be 7.5% or so. That's a pretty reasonable expectation for a long-term portfolio invested mostly in equities. Mostly meaning at least, 55 or 60%. So even though the average is 7.5% per year, you might never get exactly 7.5% in any one year, right? In most years, it's going to be above or below that number. You might have a great year and return 20%. The market might crash the next year. You might lose 15 or 20%. So from a mathematical perspective, if you organize the 30 years of returns and you rank them from worst outcome in any one year to best outcome, for you, the worst thing that can happen is you give up your income stream and you retire immediately before a market crash, to where you experience the worst possible return that you're ever going to see over your entire retirement at the very beginning after you've shut your income off, because you have the most time left in retirement at that point. You have the greatest amount of future expenses that you need to fund still from the portfolio, and you have the most at risk. So that's the worst thing that can happen, is if you experience all the worst returns first. And what a Monte Carlo analysis simply does is it goes through a whole bunch of different options and kind of shuffles things around to give you an idea of the likelihood and impact of those adverse situations, on top of the just the likelihood that such a situation is something you should be concerned about, and whether and what the impact on the rest of your retirement plan is going to be. Is what I'm trying to say there. So just to rewind a minute, what the Monte Carlo analysis allows us to do is gauge the sequence of returns risk. How important is that to your retirement income plan? If you'll be fine with 7.5% annual long-term average investment returns in your account, but the result of a Monte Carlo analysis is where if after 1,000 trials is a 40% chance of not having to make a change, well, that's not as strong as a position as we might want to start with. Now, a sequence of returns it's a risk, so it has a lot of upside too. And that's the whole point I was making earlier of, if you use the 4% rule, in 2/3 of the situation, in 2/3 of the rolling 30-year periods, do you wind up with more than twice what you started with. So even though sequence of returns can present a risk, it can also present a whole lot of upside over the course of your retirement. So what we're talking about now, what's relevant today, and the whole reason I wanted to record this week's episode on this subject, is because inflation tends to be variable too. And the sequence of inflation risk should be viewed just the exact same as sequence of returns risk. Because if you have a situation where you retire during a high inflation time, well, let me back up. If you will probably have 30 different inflation rates over each year of your 30-year retirement. And if you organize those to where the highest inflation rates occur at the very beginning of your retirement, just like if we place the worst investment returns at the beginning of your 30-year retirement, that's the worst mathematical thing that can happen. Because remember, you have the most you have a full 30 years of future expenses. And if inflation goes up at 7 or 8 or 9% like it did last year, at the very beginning, that means that all your future expenses are going to compound 1 year by that amount. And the math works out to where that's the most detrimental to your retirement plan. So we don't want to assume that the long-term average rate of inflation is going to be 2.5%, 3% every single year throughout your retirement. That's not a complete picture of what's going to happen. And so here's something that was really interesting from Kitsis's data that I wanted to try to articulate in this week's episode. If you think of it using this example, it's a really helpful starting point. Let's say that you retire from your local state government and you've worked there for a long time. You had a very great career, and you're entitled to a $10,000 pension every single month for the rest of your life. That pension, you don't pay tax on it. We're just going to ignore taxes for the moment. And it does not increase for inflation. So you get $10,000 every month for the rest of your life. If inflation is 15% and the cost of the stuff you need to buy goes up, that's on you. And so let's say that you try to coordinate this to where you spend less than the $10,000 a month at the very beginning and put that in an interest-bearing savings account. So that in your later years, when the cost of the stuff you need to buy every month goes up, you can use those savings to fund the future inflationary costs. So another way of putting that is, how much do you need to spend every single month so that after accounting for consistent inflation, you continue to spend the exact same amount over your entire 30-year retirement? And the answer is that if you use 3% a year for inflation, your $10,000 check works out to be $6,640 of after inflation spending. So what that means is that in year one, you get $10,000 deposited into your checking account. You spend $6,640 of it. The other $3,360 you put into an account that earns 3%. That 3% is the exact same rate as the 3% inflation. Okay, so in the early years, you take every dollar that's left over after spending $6,640 a month, which is $3,360. That goes into an interest-bearing account. So you're saving a lot of money in year one. Then in year two, the cost of your $6,640 of expenses goes up by 3%, meaning that you have a little bit less to save every month. But all those extra savings still go into the interest-bearing account at 3%. Well, this is over a 30-year time horizon. And somewhere around year 13, year 14, now the cost of your $6,640 of goods in year one has increased at 3% per year. Now it's up to $10,000 a month. So now you're not saving anything extra, and the money that you have in that interest-bearing account continues to grow at 3%. But then in your later years, the cost of the stuff you need to buy is greater than $10,000 a month. So you get the $10,000 from the pension, but then you have to take withdrawals from that interest-bearing account. And $6,640 in year one is the exact amount that you can spend to smooth that out to where the side account, the interest-bearing account, is exhausted at the end of that 30-year time horizon. And what happens after that is the cost of stuff you need to buy is substantially greater than $10,000 a month, but you're still getting the $10,000 a month pension. Okay. So that example is using a constant 3% rate of inflation. But as we're talking about, the worst thing that can happen mathematically is if the inflation rate all stacks up at the very beginning of your retirement and you experience the highest inflation rates first. So what the Kitces article did was researched different levels of spending using that exact same example, $10,000 a month of pension income that does not account for inflation, over rolling 30-year retirement periods, just like the 4% rule did. And what was interesting is that in 50% of, so if you want a 50% chance of success, meaning that you get to the end of the 30 years and the cost of everything that you need to buy each month is $10,000 or less. If you want a 50% chance of that being the case, then you need to spend only $6,380 of that $10,000 in year one. And the reason is because, remember, inflation rates are going up and down and up and down over this 30-year period. And that level of spending coincides with May of 1937. And the inflationary experience of retirees in May of 1937 is one that where a $10,000 pension would enable you to spend $6,380 of it and be okay 50% of the time. So the 70% chance of success, if you want a higher chance of success using all these rolling 30-year periods. Now, I misspoke just a moment ago. A 50% chance of success using all these rolling 30-year periods is $6,380. May of 1937 is that level of inflation. The subsequent 30 years is what they used as that example. If you want a higher chance of success, 70% using all these rolling 30-year periods, you can't spend quite as much. You have to spend less, or $5,800 a month. 90% chance of success, $4,650. And if you want a 100% chance of success, of the $10,000 that you have coming in every month from your pension, you can only spend $4,350 of it. And that timeline, that timing lines up with April of 1973, right after we left the gold standard. Huge inflation rates, and the one level of the one inflation experience, the one spending level, using our example, that worked in every single rolling 30-year period was $4,350. That's the same as the 4% rule, is the one rate of return that worked in all the rolling 30-year periods, 4% withdrawal rate. So what does this mean for us? Well, most people are not in a situation where they're only reliant on a pension income that does not adjust for inflation. A lot of people have pensions. A lot of people have pensions only and no retirement savings, and there's nothing wrong with that at all. But most pensions these days will give you some kind of inflation adjustment. That being said, I think most people saving for retirement and transitioning into retirement have at least some retirement savings that they plan to use and take out to fund some of their future expenses. And if we use a variable rate of inflation and incorporate this rate of inflation returns, just as we're incorporating sequence of inflation, just as we incorporate sequence of returns in our investment portfolios, how does this play into it? Well, they examined that too. And if you take a 60-40 portfolio and you want a 50% chance of success, if you use a fixed inflation rate, you can take out $60,600 per year in year one. That's using a fixed inflation rate, call it 2.75% per year, which is a pretty good long-term average. So that's a lot more than 4%, right? $60,600 is 6.06% of a $1 million portfolio. That's a lot bigger than 4%. And if you want a 70% chance of success, you spend $52,300. So 50% chance of success, 6% withdrawal, 70% chance of success, 5.23% withdrawal in year one, again, adjusting for inflation. Now, if we want to use variable inflation, which again is more reflective of what we're going to see, then your 50% chance of success needs to go down a little bit from $60,600 in year one to $60,000 even. So rather than using 6.1, you need to adjust it down to 6% on the nose. If you want a 70% chance of success, you need to adjust that 5.23% down to 4.99%, or $49,900 of withdrawals from a $1 million portfolio in year one. And again, if your withdrawal in year one is $49,900, that means that you take the rate of inflation in that year and increase your distribution the next year for whatever inflation was in year one. And so if you have all the highest inflation rates in the early part of your retirement, that means that the biggest increases are going to occur at the very beginning. $49,900 is going to go up by a lot in that first year, or in that second year, I should say. So what this means for us is that in our retirement planning, this use of Monte Carlo is really, really helpful. It's limited, and we had a podcast episode here a couple months back about how we don't want to put all our retirement planning eggs in that basket. We don't want to bet your retirement plan on just a Monte Carlo analysis, but it is a very helpful and descriptive tool and starting point to make decisions with. But what it means is that we probably need to shoot for slightly higher chances of success, meaning that we need to decrease our distribution expectations by just a little bit to account for this variability in inflation, particularly given the environment that we're in today. And this is not any kind of forecast on what the inflation rate is going to be, in Q4 of this year or, over the next couple of years. It's just the fact that we've been in a high rate of inflation environment that's coming down handily, but we're not back down all the way to that 2% target, long-term target that economists have been talking about for a long time. So that's outcome number one here is we need to incorporate this into our retirement plans. That doesn't mean we need a 100% chance of success in our Monte Carlo analysis, but it does mean that we need to err on the side of caution a little bit. Remember that chance of success is not a very descriptive term here. This is simply the chance of having to make some kind of change to your retirement plan. So if you go for a 50% chance of quote unquote success, that just means that if you have that adverse experience and things don't go so well in the first few years, you need to make some kind of adjustment to the plan, tighten the belt, take a little bit less out of the portfolio, maybe take more investment risk if the situation is right for that. I wouldn't jump to that conclusion first, but that's something to consider. These are all options on the table, and it just means that if things don't go so well, you need to make some kind of adjustment. A 100% chance of quote unquote success means that over all the history of the markets, and most of these databases will go back to at least 1927. Some of them go back to the mid 1800s. There's never been an environment with the inputs that you're telling the program where you would have run out of money, which is of course not a guarantee that it won't happen in a future market environment. It just means that there's no historical precedent for it. So those are the first few outcomes. We need to maybe haircut our or err on the side of caution in our Monte Carlo expectations. Maybe we need to reduce our withdrawal rates just by a tad to incorporate variability of inflation. But also, this is a great argument for having international exposure to international securities in your investment accounts. Stocks, bonds, maybe real estate, developed economies, emerging or developing economies as well. And the reason is that those assets are impacted differently to inflation of U.S. prices, right? If you have all your portfolio in just U.S. goods and U.S. stocks and bonds, then when the inflation rate is high, that means the stuff that you have to buy at the grocery store, the cost of it goes up. High inflation is not good for bonds. Stocks handle them a little bit better, but it's not great for stocks either. But if you have stocks in European companies or Asian companies or South American companies and bonds denominated in different countries' currencies, in high inflationary environments here, that could impact companies in other countries around the world, but it's not going to be a direct one-for-one correlation. So by having an exclusively U.S. portfolio, you're increasing your exposure to long-term inflation. And this is just a tremendous argument for having a healthy chunk of your stocks and at least some of your bonds in non-U.S. issues. It just spreads out the risk. This is also a good argument for having a reasonable allocation to risk assets in the first place in your retirement accounts. Not everybody has the capacity to take a lot of risk in your retirement portfolio. And we don't want to take that risk blindly or just because of what I'm saying on today's podcast. But most people can really stand to have some exposure to risk assets and growth assets, being stocks. Owning equities, we just have this marvelous corporate profit machine set up here in our capitalistic society in the U.S., and we have huge structures that are designed to reward shareholders of those companies. That's what the board of directors is elected to do. That's what the CEO is hired to do by the board of directors. If they don't do that, they get fired. If the board doesn't do what they should be doing, they can get voted out by the shareholders. There's just this system that really, really benefits corporate structures. For better and worse, there are a lot of arguments against this in the world we live in today, but it is what it is right now. You might as well benefit from it by having some exposure to equities. And the growth opportunities of stocks held over a long period of time, they just make the whole retirement income equation a lot easier. If you squeeze out more returns from your savings and your nest egg, it simply means you can take a little bit more out of it without risking running out in the future. So that's it for today. This concept of what does inflation mean for my retirement? It means that we need to err on the side of caution. It means that we need to incorporate variability of inflation into our planning, into our Monte Carlo simulations, into our expectations, and all that means that we need to make sure we have a healthy amount of our portfolios in non-U.S. stocks and bonds too. And we might want to round down our distribution expectations from portfolios. And what that means for you is obviously specific to your specific circumstances and situation. So that's it for today. I hope this was helpful and halfway interesting to everybody. But inflation is obviously here. Every single person listening to this has experienced inflation recently in some way, shape, or form, and we need to incorporate that into our retirement planning too. All right, talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.